This conference will now be recorded.
Well, good morning, everybody, and welcome to this latest webinar in our Harts series. And this one today is going to be on property letting and all the pitfalls and advantages, how you should set it up and so on. We have got quite a lot of people on this call, so if you could make sure you're all muted. If not, I will just mute you. Feel free to ask any questions you want. You've got the chat box in the top right hand corner of your screen. And if you want to unmute yourself and shout out any questions, this is an interactive webinar. Feel free to do so. Don't be shy. We want to answer your questions, because if you've got a question, then the chances are somebody else will as well. The session's being recorded and will appear on our YouTube channel later on today. So if you miss anything or you want to go over anything, then you can go to YouTube, search for Harts Limited with limited spelt in full, and you'll be able to catch up on anything that you've missed. We have our usual disclaimer that we have to run through. So the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. As always, we give you a quick update as to what's going on. So we've got the national insurance threshold does increase to £12,570 from July. So hopefully this will offset some of your increase of the national insurance rise that's happened already, which is a bit lower down on that screen. So you already see some reductions in your pay as a result of the 1.25% increase. 1p off income tax, but not until 2024. However, there has just been murmurings in the press yesterday and today about potential tax cuts even sooner than that. So watch this space. We won't wait to see what happens, because that could all be to do with the cost of living squeeze and so on. The employment allowance has increased to £5,000, so make sure you're taking advantage of that. If we're doing your payroll for you, obviously that will happen automatically. And make use of the super deduction. So if you're looking to buy any equipment, now's the time to do it. It runs out next year, next April. You're getting 130% of your allowances, so 130% of your cost of any capital equipment. So make sure you make use of that. As we mentioned on a few previous webinars, and nothing has changed, so we're going to mention it again, make no apologies for this, child benefit. HMRC are looking at this, and so if you have claimed child benefit and you shouldn't have done, then the HMRC are going to come after you. You can minimize any risk or mitigate any risk of that by coming clean and just make sure you're paying it back. Just as a quick reminder, if you're earning over £50,000, then your child benefit starts to abate. If you earn over £60,000, you're not entitled to anything. Now that's in per household. So if there's two of you living in the household, one of you is earning over 60,000, you have to repay all your child benefit. However, if two of you are earning 49,000, then you can still get it in full. Crazy rules, but that's what they are. Don't shoot the messenger. They're also on the attack on job retention scheme payments. So if you've claimed when you shouldn't have done, HMRC are looking at this quite closely now, and there are proposals to make company directors personally liable for this if you don't repay it. Much the same with bounce back loans and the CBILS loans. If you have taken those loans and you weren't entitled to them, or you've taken too much, just be aware that is being looked at. The Let Property campaign is still open, and that links to very much what we're saying today. I'm not sure if, Chris, you're going to cover that later on. But okay, so the Let Property campaign is still open. So if you are receiving rental income and you haven't declared it for whatever reason, maybe mistakenly, maybe you thought there wasn't any profit or you didn't have to, there is a disclosure facility available which will minimize the penalties that are payable. So if you want any help with that, please get in touch. We've done a number of these, so don't be afraid of coming forward. You're not going to prison. It's just a question of settling what you owe. And HMRC has started to issue assessments for overpaid self-employed grants. So here again, if you've claimed too much, They are after you if you are self-employed, so just bear that in mind. If you've got any questions on this, just get in touch. We're happy to help and guide you through the process. Please make sure of other Harts online resources. Follow us on LinkedIn. There's plenty happening on LinkedIn. We're aiming to get our followers up to 1,000 rather. If you're not a follower of Harts, please do so. That's our target for the end of the year. We want to hit 1,000 followers. We're over halfway there, so it'd be great if you could follow us and get other people to do so. Follow us on YouTube as well, so every time a new video gets posted on there, then you'll be able to see it, you'll be notified of it. And follow us on Twitter as well, at Harts Accountants. And finally from me, the next webinars in a couple of weeks' time, we're looking at research development and what you can claim, what you can't claim, its advantages, eligibility. And bear in mind, it's not all people in white coats sitting in labs. There's a lot more you can claim for. On the 9th of June, how to prepare a marketing plan. One of the things that I see regularly when I'm working with businesses is that they don't know how to do a marketing plan and what you need to do and what's involved. So we'll hope we guide you through that process. And finally, before the summer break, on the 23rd of June, we're going to have a look at the cost of living squeeze. What can we do about it? Have your say. It'll be a very interactive session, that one. It'll be great to have a good chat with everybody. And after that, we'll be back in September. If you've got any suggestions you want for any future webinars, please get in touch. And you can book on any of these seminars by going to the events page and booking on our website. That's it from me this morning, but unless you've got any questions, and we're going through the questions and answers at the end, I'm going to hand over now to two of our senior tax people. We have Chris Bentley, who's our Tax and Forensic Director, and Alison Ward, who is our Tax Manager, Senior Manager. And they have plenty of experience in dealing with these areas, far more experience than I have. But I'm going to hand it over to them, and they're going to guide you through property letting. So over to you, Chris.
Yes, good morning, everyone. Hopefully you can see my screen, and hopefully this time the slides will behave and do what they're supposed to do. So as Stephen has said, this morning's webinar is on property and specifically property letting. Hang on, if I can move on to the next slide. No. Unfortunately, Stephen, I think you're going to have to be presenter and I'm going to have to ask you to change the slides. Oh, no, it's
done it. There you go.
Yeah, so let's move on to the next slide, please, Stephen.
You've done it.
Oh, have I?
Yeah.
No. I think I need you. There's a long delay. I press a button and nothing happens. So.
Okay, bear with me 1 second. Just if you want to talk amongst yourselves for a minute, bear with me 1 sec. Okay, hopefully you can all see that screen. And we've done that one, and there's a second disclaimer here as well.
Sorry, if I can just come back onto the first page of disclaimers. The nature of this presentation means that we do need a couple more disclaimers than usual. The following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. In this presentation and throughout this webinar, it's assumed that all individuals and shareholders and directors of any limited company referred to are all UK tax residents. We're also assuming that any property that we consider is in the UK. These are absolutely critical assumptions and are critical to any tax analysis. Therefore, if you have someone in your company who might be French resident, you need separate advice. If the property is abroad, separate advice. The tax considerations if you are buying commercial property for use in your business rather than letting it out are very different to those that we cover in this presentation. They're beyond the scope. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Right, thank you. If we can now move on to the presentation itself. And again, Stephen. So the bit you're all here for, property letting. How often, the number of times that we're asked personal or limited company ownership, it's enormous. So we'll run you through some of the key considerations. That's both from the income side and from the capital gains side, should you ultimately come to sell those properties. Quite often people come to us with a view that it is automatically the case that residential property should be in a limited company, and if it's not in a limited company, it needs to be transferred as soon as possible. That's wrong. Full stop. There isn't a single answer for everyone. Whether you should hold property efficiently, more tax efficiently, personally, jointly, or through your limited company is a complex question, and there isn't not a single answer for everyone. So today we're going to go through the major differences between the two structures, personal or limited company ownership, and outline the basic pros and cons, which are essentially the taxation of the income under each structure, the extraction of profit under each structure, and then the eventual sale of the property under each structure. And at this point, to go through on the income side in a little more detail, I'm going to hand over to Alison.
Hi, good morning, everyone. Right, so you can see on this screen here, we've got, there's actually 3 structures that we are going to be looking at, because personal ownership, we can actually split out into you owning it personally, so all the rental profit will be taxed on you. Or if you've got a spouse or a civil partner, then maybe it will be more beneficial. Again, it depends on individual circumstances. If you bring your spouse, civil partner on board and you own that property jointly, and then you can split that rental profit in the most tax efficient manner. And then the third option we're going to look at is, should you be putting buying properties through the limited company, wherefore the rental profit will then be taxed on the company at corporation tax rates. So if we move on to the next slide. So personal ownership, we're going to look at the pros and the cons. So what might lead you to keep rental property in your own name? Now, the first thing to consider, and it's quite an important consideration outside of tax really, is that the income is all yours to spend. So you receive it all, you get taxed on it, but then after you've paid the tax, it's yours to do with as you wish. So if you're actually somebody who maybe it's your only source of income, and maybe you're even into higher rate, then in some circumstances it could still be more beneficial for you to keep those properties in your own name and pay the tax that is due, but then you've got the income to live off if that's what you need to do. Whereas if you're going to put it through a company, as we'll see later, you could be suffering double taxation if all you're going to do is take all of that money out again because you need to live on it. So it's an important consideration outside of tax really, is do you need that income to live on, or do you not really need it to live on right now? But if you need it to live on, then it's definitely a pro that you keep it in your own personal ownership. The second pro for keeping it in your own personal ownership is if you are a basic rate taxpayer. So each person can earn up to £50,270 per tax year at the moment. And if your rental income and all your other income, when you combine that together, is below that level, then you're only going to pay tax at 20%. So it's probably going to be more efficient to keep it in your own name at that point. Maybe you own these properties outright, or you have very little mortgage on them. So you're not actually paying any mortgage interest. Now, as we will go into in more depth, there have been changes to the tax relief you can get on mortgage interest if you own residential property personally. But if that's not an issue for you because you're not using mortgages, then again, it's not a driver that would send you in particular to have to set up a limited company. You could quite happily carry on owning those properties in your own name. And the next point is you already own these properties. So as Chris mentioned at the beginning, there's a misunderstanding that people think they need to transfer their property portfolio into a limited company. Unfortunately, that's going to cost you, because when you transfer property out of your own name into a limited company, which is a separate legal entity, we have to look at the capital gains tax position. So you could end up having to pay capital gains. And in addition to that, we've got to look at the stamp duty position. So possibly there's two taxes there that you're going to have to pay upfront just to get those properties out of your name into that limited company, which means any tax benefits you're going to get from it being in the company have got to be significant to outweigh the initial cost of you moving those properties. So it's quite often, it's just not viable to move properties that you already own into a limited company. Instead, what you might be wanting to do is start up a limited company with new property purchases. If you're someone who is looking to carry on expanding your portfolio, then there's going to come a point when you need to consider, I can't hold any more personally, so I'll have to think of a limited company. And then the last pro on the personal ownership side is a lot of these problems if you're holding residential properties. If you're holding commercial or what we call furnished holiday lets, then these aren't considered to be residential. They are considered commercial. Even the furnished holiday lets are considered to be business properties. So the interest issues that we have, the tax relief on the interest, that doesn't come into play at all. So what are the cons of personal ownership? At which point is it going to start to cost you? So yes, if you breach that £50,270 per annum, then you start getting pushed into higher rate tax. So say you're a new investor, you've already got a job that makes you use up your basic rate band, then you might be somebody that would think about buying a property or starting a residential property portfolio through a limited company, because you already know that you would be a higher rate taxpayer if you took it on personally. And if your plans are that the properties you want to buy are all going to be residential, then again, personal ownership might not be the route for you. But the big one is the limited deductibility of mortgage interest. So this started to get phased in from about 2017, where you were only allowed a limited amount of the interest as a deduction, as an expense against the rental income. Now that we've got to 2020, it was fully phased in, which means there is now no deduction against your rental income. So the mortgage interest cannot be taken into account in working out what your taxable rental profit is. So that could have a significant impact on how much your rental profit is and at what rate of tax you're going to pay on that rental profit. The way that you get tax relief now is it's called a 20% tax credit. So once we've worked out your tax liability with that higher rental profit figure, we will then deduct 20% of the mortgage interest off your tax liability. So if you were someone who beforehand you were quite highly geared, quite highly mortgaged, then you're going to find quite a big impact in that your rental profit will have gone up, potentially pushing you into higher rates. You're going to pay 40% on that rental profit, but you're only going to get mortgage interest relief at 20%. So another downside to personal ownership, so this is the opposite of what we talked about earlier, in that actually you don't need to live on this money. You've got a well-paying job and you're really looking at the properties as sort of your future pension pot. So you don't need that money, you're not using it, you're just building it up. But actually you're getting taxed on all of it right now. So maybe that's not the right situation for you. And then the final downside to personal ownership is something that is in the pipeline to start from the 1st of April 2024. So we've got another couple of years yet, but this making tax digital is going to affect people who are landlords, people who rent property. HMRC want to make landlords who have more than £10,000 gross rental income per annum, they want them to do quarterly tax returns. So as a quarter ends, you will then have to do the tax return in quite quick succession, we believe. We don't know all the full details, but this is what we believe. And that's going to, increase the admin burden and the tax costs if you need to pay somebody to do that for you. And you would still need to do the annual self-assessment tax return. So that's in effect 5 tax returns that you would have to do. So that's could be quite a big con coming up. So if we move on to the next slide, please, Stephen. Okay, so maybe we've realised that we have got a bit of a problem because we are getting pushed into higher rate, or if we bought new property, we would be pushed into higher rate. But do we automatically need to think about a limited company, or are there some other possibilities? Well, one possibility is if you've got a spouse or a civil partner, you could share ownership with them, especially if, say, you're a higher earner, but they're a low earner or perhaps not earning at all at the moment, because they've still got a personal allowance and they've still got the basic rate band. So it's quite possible that you could buy a property or transfer a property into joint names. So legally you jointly own this property. And if that's all you did, then you would have to split the income 50-50, because in the eyes of HMRC, that's how you would have to do it. But you can take steps if it's actually more beneficial to split it, say 80-20 or 90-10 in favour of the low earning spouse. And the way you would do this, you would have to do something called a declaration of trust or a deed of gift. So a solicitor could put that together for you, where you basically say legally you own the property 50-50, but the beneficial ownership is split 80-20 or whatever you decide is most tax efficient for your personal circumstances. And then you can lodge that with HMRC with a form that they want you to fill in. And once that's been lodged, from that date forward, you can then split the income 80-20, 90-10 going forward. And that helps you make the best use of your personal allowances, your basic rate bands. So, that could be the answer. If you've got a couple of properties, but one of you starting to go into higher rate, look at, transferring them into joint names. And the benefit with spouses and civil partners is that you transfer properties between you, there is no capital gains to worry about. Now, the possible con is that there might be stamp duty to think about. You may not be exchanging money when you transfer these properties between each other, but if there is mortgage debt, and say one person owned it to begin with and you're transferring it into joint names, then you are transferring mortgage debt from one spouse to the other, and there is potentially stamp duty on that. But the benefit of you being spouses is that you would get this transfer at the normal rates of stamp duty. Now, the reason why I bring that in at this point is that when we're talking about buying residential property for letting, most of, in 99% of cases, people are buying a second property. So that means the higher rates of stamp duty are going to come into play. So whatever band you're buying in, you take the normal stamp duty rate and you add another 3%. But when it comes to transfers between spouses, there's a special exemption, which means you don't have to apply that higher rate. So basically what we're talking about is if you're transferring mortgage debt of up to £125,000, then the rate is going to be the normal rate of 0%. So there's some flexibility there, but it is something that you need to think about when you're transferring mortgage debt. Obviously, if you've got no mortgage and you're just doing this to get your tax rates down, then that's not consideration. And then, of course, the final con on this side is, as we've just mentioned, the requirement to file these quarterly returns. Again, you might be able to avoid it if you've split the rental income between both of you, because that might mean that each you are then below the 10,000 rate. This is what we're assuming. As I say, the final details aren't public knowledge at the moment, but that's a potential. But otherwise, you would both have to be into this Making Tax Digital regime. Okay, so if we move on to the next slide, Stephen. So finally, just one back, sorry. That's it. So finally, we've got the limited company ownership. So when is it beneficial to start thinking about holding through a limited company? So yes, if you've got residential property that you're hoping to purchase, and if you're already a higher rate taxpayer, or if you know that the rental yield from this next property that you're going to buy is going to make you a higher rate taxpayer, and also if you are heavily relying on mortgages to buy your property portfolio, then these are the three key things that would probably make it beneficial for you to think about a limited company structure. Now, the benefits of limited company structure is you would have something called the director's loan account. So if you say the first property that you want to buy into this company, you would probably need to lend it some startup money, at least to say pay the deposit to buy the property. Well, that's you loaning money to your company. So that sits on your director's loan account as money owed back to you. Now, once the company starts making a profit, then you can pay yourself back out of that director's loan account, and that extraction is completely tax-free. So you can do that until you have paid yourself back. Another benefit is that it's much easier through a limited company structure to pass on your property portfolio, because what you can do is you can introduce your daughters, sons, whoever it is you want to pass on this eventual property portfolio to, you can introduce them as directors if you want to and pay them salaries, or you could introduce them just as shareholders. And then as time goes by, if you want to say step back, you can start transferring your shares across to whoever it is you want to pass on. Now, by doing that, you can spread that over a number of tax years, because you, of course, when you make transfers like that, you do have to consider capital gains tax, but you have got an annual capital exemption of 12,300 at the moment per tax year. So you could spread out the transferring of the shares over a number of years as you wind down your involvement and make use of those exemptions to try and minimise the capital gains tax. And the final pro is obviously, at the moment, HMRC are not talking about limited companies that own property being dragged into the MTD. For companies, the main trigger point for MTD is if you are VAT registered. And if we're talking about holding residential properties for letting out, then that is not a VATable activity. So far, limited companies owning property are not in HMRC's site for Making Tax Digital. But the downside of a limited company ownership and things you need to think about carefully is how are you going to get your income out? Because it's not your money at the end of the day. And as we talked about with the personal tax side, if you are somebody who's going to want to extract all of the money and live on it and use it just like you would do now, then it's potentially not going to work for you. The limited company route works best for people who have a long-term plan and they're trying to build something up either for a future retirement pot or because they know they want to pass it on to the next generation. So they actually don't need the money right now, and they're quite happy to roll it up as much as possible, reinvest it, buy more property. And maybe there's going to be a point down the line where they're not working anymore, so they've got a basic rate band available, then maybe they've got a personal allowance available, and there'll come a point then where they can be more flexible with what they can take out of the limited company. Because once you've paid yourself back on the director's loan account, then your only options are salary and dividends. So salary, if you've already got another job, then you've already used your personal allowance against that. So you may not be in a position to take a salary out of your limited company right now. So then dividends. Well, you're allowed £2,000 per annum, per tax year, completely tax-free. And if you, your spouse, your adult children, if you're all shareholders, then you each can take £2,000. But after that, you'd be paying tax. And the tax rates on dividends have recently gone up this year. So we're looking at 8.75% if you're taking it within the basic rate band. If it takes you into the higher rate band, you're looking at 33.75%. And if it takes you into the additional higher rate, so over £150,000 worth of total income, you're looking at 39.35%. So it does need careful planning whilst you've got another job, which is why we stress that it's probably the best if you're looking at a long-term view and you don't need the money right now. It's worth mentioning that when you do run a limited company, you've obviously got additional accountancy and tax requirements. So you have to do accounts that are going to comply with Companies House. You have to submit them. You've got a deadline for submitting them. You have to do corporation tax returns. And there'll be other company admin that you would have just because you now have this limited company. It's also likely that you'll be looking at higher mortgage rates to get a company mortgage rather than an individual mortgage. But what I will say is the market out there is certainly a lot better than it used to be, because obviously there's been quite a lot of demand for it as people have shifted to limited companies owning property. But it's just something to be aware of. And then the final thing just to note is this corporation tax rate is set to increase from the 1st of April next year to 25%. It's currently 19%. So obviously the tax saving you're looking at the moment is paying 40% in your own name compared to 19% in the company. But that's going to shift from next year. And as we said all along, whether it remains tax efficient, it really does depend on the individual circumstances of each person involved, which is why there is no right answer for everyone. It is a case of looking at the pros and cons and weighing them up and coming up with the best answer for you. Okay, so at this point, I'm going to pass back to Chris while he just summarises that and then moves on to the capital side.
Thank you very much, Alison. It's a very good and detailed summary of the pros and cons of each ownership structure. I'm just going to round up the income side with a final slide that sets out some of the factors that might point you towards personal or joint, or on the other side, company ownership of your properties. As we've said all the way through, there is no right or wrong answer for everyone. It does depend on your personal circumstances. But if we look at this slide, the things on the personal side, if you're looking more at that, then you're probably looking more towards personal joint ownership. On the other side, if your factors are more those on the company side, you might be more likely to be appropriate for company ownership for your residential buy-to-let properties. So on the personal side, so if you're spending the income, that points towards personal or joint ownership. Conversely, if you're reinvesting, that might point towards company ownership. If it's only got a small mortgage or no mortgage, that's pointing towards personal or joint ownership, whereas heavily mortgaged properties tend to be pointing towards company ownership. Basic rate taxpayers, those with a low or non-earning spouse, there's a lot of planning that can be done to make sure the income is taxable at basic rate. Basic rate income tax is 20%. Corporation tax, as Alison has said, from next April will be 25%, and then you've got to pay to get the money out of the company. So a company ownership is more appropriate to the higher rate taxpayer who's got no opportunity to shift the income. Alison started going into when the properties are likely to be sold. If you're selling before death, whether to fund retirement or otherwise, that might be a reason to hold them personally or jointly. And I'll come on to the capital gains taxation shortly. As Alison said, passing on to the next generation is easier with shares in some ways, but there is a potential fail in that one. If you die unexpectedly, a company owning shares in a property company is not a good asset for inheritance tax purposes. Someone may well have to raise money, borrow money to fund the inheritance tax bill. It's just something to bear in mind on that one. So there are then two areas where personal ownership makes sense, and it's unusual to want to move. The first, as Alison has said, if you already own your property personally or jointly, it's unlikely that moving it to limited company ownership is going to make sense. And the reason for that is the capital gains tax charges and the stamp duty land tax charges that arise. There are exceptions to that rule, but they are unusual and few and far between. So in most cases, if you already own your property personally or jointly, it's best to leave it that way. And if you're buying in the future, you're then considering personal or company ownership. There are other types of property. We focused very heavily on residential buy-to-lets, as that's where we get most questions. But if you're doing furnished holiday lets or Airbnb activity or commercial property, then those types of property, the equation is different, and it's the pros, as Alison has suggested, are much stronger for holding in your personal name. But you do, with holiday lets, Airbnb and commercial property, you do need to at least have one eye on the VAT side of things. So if I then ask Stephen to roll on, and we can have a quick look at the capital gains tax side. So when you ultimately come to sell those properties and what the tax consequences might be. These slides are based on the regime applying as at today's date. If you're selling 2, 3, 5, 10 years in the future, please do bear in mind that there is a lot of time for the government to change the rules. So if you sell residential property personally, then you'll pay capital gains tax at either 18 or 28%. It's higher rates for residential property as compared to commercial property or shares. There's no business asset disposal relief or entrepreneurs relief on selling residential buy-to-let. Most people who are selling will probably pay at 28% because the gain will take them into higher rate tax. You have to report the sale and pay an estimate of the capital gains tax within 60 days of the disposal. But the regime isn't that bad. You do get a capital gains tax annual exemption of £12,300 each. If you've ever lived in that property as your only or main home, there may well be additional reliefs due on the sale. And there are also lower rates of capital gains tax for commercial property and furnished holiday lets. So we then come over to the next page. So if you've now got the property held jointly, then much of the capital gains tax is the same as previously. The tax rates are the same. However, you've now got two annual exempt amounts, so two lots of 12,300 that you can use against the disposal tax-free. You don't get that in a company. You might also have split the gain to such a level that you're both now basic rate taxpayers and paying 18% on the taxable element of the gain, and none of it's taxable at 28%. So the downside, though, if there is tax, is that there'll be 2 60-day returns needed if it's residential property. So one piece of planning that's often undertaken at this point is, even if the property has been in single ownership prior to sale, people might put it into joint ownership 6 months before disposal. Alternatively, if it's in joint ownership but that's uneven, moving back to a standard 50-50 split before the disposal to make best use of the capital gains tax annual exemptions and potentially also the unused basic rate band. Next slide, please, Stephen. If you sell property through a limited company, the tax regime is very different. The starting point is that the disposal of the property is taxed at corporation tax rates. That's 19%, but will increase to 25% from April next year. So that's higher than a basic rate taxpayer, but still slightly lower than a higher rate taxpayer. However, there's no annual exemption amount for companies, so the whole gain is taxable. There are no 60 days returns, which is welcome, but compared to the tax rate is a small part. The disposal proceeds after tax belong to the company. So if you've sold the property in the company, you've paid the corporation tax, we now need to think around whether or how much the additional tax is to get that money out of the limited company. Not a problem if you're reinvesting it in a new buy-to-let or a new property, but if you want to spend that, we need to take it out. So the working assumption at this point is that the director's loan account has probably been used either from income you've drawn out over the years, or it's used up by the amount you put in to buy the property. That can come out, but the profit is still going to be subject to tax. If there are still properties in the company, then the most likely route you'll want to take the money out by is by way of dividends, because it's more tax efficient than salary. However, by the time you've paid the corporation tax and then you've paid additional personal tax on the dividends, then the effective tax rate for a higher rate taxpayer is often close to 50%, unless you're able to wind up the company. Winding up the company, which is my next slide, is only appropriate if there are no longer any properties in there, because you're closing the company. So before you can wind up the company, you would need to sell all of the properties within the company and pay the corporation tax on those disposals. And then you would look to extract the remaining reserves by way of a liquidation of that company. So that involves getting in a licensed insolvency practitioner who can put the company into what's known as liquidation. It's a solvent liquidation. It's not a stain on your records. But it is a process that has to be gone through, and a liquidator is not particularly cheap. When the benefit of having the money coming out through a liquidation as opposed to dividends is that you pay capital gains tax on the proceeds that come out, not income tax on a dividend. The capital gains tax, the top rate for a disposal of shares is 20% after the annual exempt amount. On a residential buy-to-let company, you're not going to get business asset disposal relief. It's an investment company. So the total effective tax rate, and I'm not going to go through the maths at this point, is likely to be in the region of 40% once you've taken the corporation tax and the personal capital gains tax both into account. And then the final one, if Stephen flicks it over, is if you can get there, is actually to sell the limited company shares as a whole. If you can manage it, this will give you the best tax rate possible for disposing of properties that are in a limited company. So here, because you're selling shares rather than a company, rather than a property, you're looking at 20% tax being the top tax rate. But again, no business asset disposal relief or entrepreneurs relief as this is an investment company. And because you're selling the whole company, not individual properties, again, you've got no capital gains tax to worry about within the company itself. So it is much more tax efficient, but it requires a complete exit, an investor who wishes to buy the entire portfolio, which is possibly unlikely in practice. Okay, thank you. And then if we move on to the final slide, which is our next webinar, which is on research and development, as Stephen has made out already, and will take place 2 weeks today at 9:30. And I think it's now time to move on to any questions.
Great. So if anyone's got any questions on anything they've heard this morning, feel free to stick it in the chat box. It's available to you, or just unmute yourself. Click on the microphone button on the bottom of your screen, and just unmute yourself and shout out. We know there's going to be loads of issues that you might have personally. If you want to get in touch with us, just feel free to drop us an email, give us a call. Happily answer all of your questions. So has anybody got anything they want to ask at this stage? Well, what we will do is we'll stay online after we stop the recording for about 5 minutes. If anybody wants to ask something when it's not being recorded, that's absolutely fine. First question we've had is, how many years of unused capital gains allowance can you use?
None. It's a use it or lose it allowance. So in the current tax year, you can use your 22-23 allowance, but that's it.
Anybody else got any questions at the moment? No. Great. Well, thank you all very much indeed for joining us this morning. We look forward to seeing you in a fortnight's time on our research and development webinar. If you want to catch up on anything here, please feel free to let us know, and you can catch up on the YouTube channel. We've actually got a couple of more questions just quickly come in. How is capital gains calculated on a property?
It's broadly your sales proceeds less your cost of disposal, so your legal fees, estate agents' fees, etc., less your purchase price, less your acquisition costs, which would include your stamp duty, land tax, less any significant capital expenditure. And that's deliberately woolly. I would expect things like an extension to qualify, but not your repairs and maintenance.
And not your outstanding mortgage balance, because I've seen a few assumptions made that you can knock off what you still owe on your mortgage, but you can't. It's completely irrelevant.
Yeah, thank you, Alison. The mortgage is irrelevant to the capital gains calculation.
Okay. And final question, does the increase in corporation tax rate to 25% apply to all companies irrespective of size?
There's two answers to that one. If you're talking about property companies, investment companies, then the answer is yes. If you're talking about trading businesses, then the answer is no. The smallest trading companies will continue with profits of less than 50,000 will continue to pay corporation tax at 19%. But there are also complex rules that if you have multiple companies, the thresholds, the lower rates are apportioned between those companies.
And finally, any indexation allowance?
Not anymore. If you had a company that owned property before, I think it was December 17. So I'm just looking at Alison in companies.
You still get it in a company,
if you had
but it's frozen
at December 17.
Yeah, but you don't get it at all if you're selling personally.
Correct.
Okay. And this really is the final one. If you sell the property, pay the capital gains tax, could you then drain the money out of the company's income over a few years rather than winding up? The answer to that is yes, you can. You could just continue to take the dividends out at £2,000 a year, which is currently tax-free, and you could just continue to drain that money out. Thank you very much indeed for everybody joining us today, and we'll hopefully see you soon.
Thank you. Bye-bye.